Most business owners pick their operational structure for one specific reason: tax efficiency. They sit down with an accountant, look at the numbers, and set up the entity that keeps the most cash in the business. In Australia, that usually means choosing between four main options. You operate as a sole trader, a company, a partnership, or a trust. But a business structure is a rigid legal liability boundary. It dictates exactly who holds the risk and exactly who can be sued. If the insured name on your policy does not perfectly match your legal trading entity, your insurance coverage is legally invalid. This administrative mismatch is one of the most common reasons insurance claims get denied in Australia. It catches founders out right at the moment they need the cash to survive. Look at this quadrant chart comparing tax efficiency to liability protection. A growing business will often upgrade its structure, moving from a sole trader setup to a company or trust to optimize its taxes. But they often fail to bring their insurance along for the ride. The legal protection you gain from upgrading your business structure is a complete illusion if your insurance paperwork doesn't mirror your new operational reality. Let's start with the sole trader. It is the easiest way to get a business off the ground. The administrative demands are minimal and the setup costs are low. This matrix shows how that simplicity comes at a steep price: unlimited personal liability. As you can see, there is zero legal separation between you as an individual and your business operations. If a client or a supplier sues your business for $200,000, they aren't just going after your business accounts. Your personal house, your car, and your life savings are directly on the table to settle that debt. To counter this risk, the required setup is straightforward. You need public liability, and if you provide professional advice, professional indemnity. Because there is no legal barrier between you and the business, these policies have to be issued in your exact personal name, not your trading name. And since there is no underlying business entity to keep generating revenue if you get injured, income protection insurance is a critical addition. If you can't work, the cash flow stops immediately. A sole trader setup saves you money on admin and taxes early on, but those upfront savings are negligible compared to the personal financial devastation of facing a lawsuit without the right cover. Partnerships offer a logical next step. You pool your resources, share the capital burden, and split the daily workload with someone else. But row 2 of our matrix reveals the hidden structural trap of a partnership. It is a concept called joint and several liability. Here is what that actually means. If your partner makes a catastrophic error, gets sued, and doesn't have the personal funds to pay the settlement, the court can legally seize your personal assets to cover the entire debt. You are 100% financially responsible for your partner's mistake, even if you had absolutely zero involvement in that specific project. The specific insurance mechanism you need here is a professional indemnity policy that includes a cross-liability clause. That clause is crucial because it covers claims made between the partners themselves, rather than just protecting the partnership from external client lawsuits. Add key person insurance if one partner brings in the bulk of the revenue, and make sure you have a watertight, formalized partnership agreement. Trusting your business partner is necessary, but it is never enough. You have to engineer the right legal and insurance barriers to protect yourselves from each other's liabilities. When founders want to scale, they usually incorporate. Upgrading to a Pty Ltd company creates a separate legal entity. The perceived benefit here is a heavy corporate shield. In theory, this structure protects your personal assets from general business creditors. In our matrix, you can see the corporate shield in place. But look at these red bypass arrows. Breaches of director duties, trading while insolvent, or wrongful dismissal claims will slice right past that shield and expose you personally. To block those bypass arrows, you need management liability insurance. It is designed specifically to protect directors personally. And if your new company hires employees, workers' compensation is no longer optional. It becomes a strict legal requirement in every state. This is where we see a high frequency of administrative lag. Founders incorporate the business, but forget to transfer their existing insurance out of their personal name and into the new company name. Incorporating gives you a powerful corporate shield, but without management liability coverage and meticulously updated policy names, the directors operating behind that shield remain entirely exposed. That brings us to trusts. These are top-tier structures, highly effective for family asset protection and flexible tax distribution. This flowchart illustrates the operational reality of a trust. The trust itself simply holds the business assets. A designated trustee actually runs the daily operations and distributes profits to the beneficiaries. But this setup carries a massive hidden risk. By default, human trustees are personally liable for the trust's debts. To fix this, professionals set up a corporate trustee, a PTY Ltd company. This places a corporate barrier around the active manager, shielding the human beings. This complex setup demands highly specialized coverage. Your policies must explicitly name both the trust and the trustees. And if you use a corporate trustee, you need directors and officers insurance for the people running that company. Trusts offer superior tax benefits, but they require constant maintenance. Failing to explicitly insure the trustee structure guarantees a catastrophic gap in your protection. The ultimate rule here is simple. Your business insurance must systematically evolve on the exact day your legal structure evolves. Here is a 4-step audit to make sure yours aligns. Step 1. Immediately verify your exact current legal structure by checking your ABN registration. Step 2. Pull your current insurance schedule. Check the named insured on the document and ensure it perfectly matches the legal structure you just verified. Step 3. Look for structural gaps. If you are in a partnership, look for cross-liability coverage. If you run a company, verify you have management liability in place. Do not rely on automated online insurance portals to fix these gaps. Algorithms cannot accurately parse the complex nuances of a trust deed or a partnership agreement. Step 4. You must work with a specialist broker. You need an advisor who asks about your legal structure before they even ask about your industry. A mismatch between your entity and your policy can turn years of premiums into a total loss, leaving you to face a lawsuit with zero corporate or personal protection. Ensuring your insurance paperwork mirrors your legal reality is the only way to guarantee those premiums actually deliver a payout at the moment you need it most.